Coming up today, the Nasdaq hits a new record, led by Nvidia. What's behind this rally? A look at the AI boom, meme mania coming back, one of the cheapest stock markets in the world, and the change in how stocks settle is now live. Hey, what's up guys? Welcome back to the Click Capital Daily Market Review. Hope you're all doing well out there. My name's Jared, and I'm going to get you all up to date on everything important happening across financial markets, just as I do every day. So if you haven't already, don't forget to hit that subscribe and like button, and you'll keep staying ahead of the markets. And so this is a shortened trading week, only 4 trading days after markets were closed yesterday in observance of Memorial Day. And we've kicked off the week on another bit of a consolidation, and what's looking like a similar pattern after the last time we got that bearish engulfing candle on the 4th of April. Market consolidated for 3 days before falling over, and the same thing happened back in July last year. Market came to a bit of a stop, big bearish engulfing, 3 days of consolidation before rolling over for a few months. However, the market rarely makes it that easy. Typically when things happen a couple of times, the market catches on, and it doesn't always just repeat in lockstep the same every time. So I'm not exactly expecting the stock market S&P 500 to roll over like it did the last 2 times. I think we're more in for a period of consolidation here, as we've got a lot of tailwinds for the stock market and a little bit of a changing dynamic as I speak. Just looking at market color, we now got bond yields, oil, energy, and inflation expectations back to uptrending across the board. Only real growth risk on sector that's currently in a strong uptrend is semiconductors, thanks to Nvidia, and that has spilled over to other semis as well. We can see that with AMD catching a bid. Strong price action today for British chipmaker ARM Holding, up 9% on volume. Broadcom looking technically constructive with a bull flag here. But the star of the show, the big fella, Nvidia, up another whopping 7% today on huge volume, 65 million shares. Volume still increasing even as the stock price explodes upwards. Just a huge amount of volume, and now within a stone's throw of becoming the world's largest company, something I've been calling for all year. As my daily regular viewers know, I expect Nvidia to overtake Apple and Microsoft, potentially in the coming days, if not weeks. But my forecast was always for some point this year. And with Nvidia's market cap currently at 2.85 trillion, within an inch of Apple's at 2.91, and not that far away from Microsoft's 3.2 trillion market cap either. And so the melt up is well underway in Nvidia. The fundamentals are as strong as you'll ever see in any large cap company, possibly in our lifetimes, as we're still ushering in what you could call the 5th largest technology revolution of our lifetimes as well. You could think of the first as the PC revolution, which really took off in the 80s, people getting personal computers at home. Going on to the second revolution in the 90s with the internet, that becoming mainstream. Then in the 2000s, it was mobile and smartphones being adopted worldwide. Then you could think of the 4th revolution as cloud in the 2010s. The move from storing data locally on hardware onto the cloud, the internet. And so you could think of the 5th revolution, the 2020s, as artificial intelligence. With some saying Nvidia still has 258% upside and could potentially reach 10 trillion in valuation by 2030. And even though Nvidia is still trading on momentum after their blowout Q1 earnings, what really kicked on the rally today was news of Elon Musk's XAI raising $6 billion, now with a valuation of $24 billion, and they said that money will be used on their first products and to build advanced infrastructure, in which they said they're going to buy Nvidia GPU chips. So big companies around the world just can't spend enough with Nvidia. They're basically paying any price, and that's why Nvidia is absolutely crushing it with 80% gross operating margins, which is unheard of for a company of their size. And there's a look at the XAI website with their main product Grok, the competitor to ChatGPT, Google's Gemini, a large language model, LLM, chatbot integrated into X. And Elon's always had his hand in AI. A lot of people don't know, but he actually invested $100 million into ChatGPT owner OpenAI 10 years ago with the vision of it becoming exactly as the name of the company says, OpenAI. However, since Microsoft got involved, you could actually think of it as closed AI, for profit and with a woke tilt as well in their reasoning and answering of questions. However, like Elon's always said, the purpose of XAI is to truly understand the universe and what's the truth, what's the data, what's the science, instead of aligning with a certain ideology that we see out of most of these large tech companies, especially Meta, the owner of Facebook and Instagram. So this boom in CapEx, capital expending by companies on GPUs, showing no signs of slowing. AI revolution is well and underway. And just looking at the 10-year percentage change in Nvidia versus Microsoft in the previous tech bubble of the late 90s. Microsoft got up to about 14,000% change in its stock price over 10 years at the peak in 99. Nvidia's already eclipsed that, currently over 20,000% its return in the last 10 years. This is probably the best performing stock most of our lifetimes in terms of a large cap. And believe it or not, initial forecasts for the previous 4 tech revolutions, on average, underestimated the growth in underlying users of the technology by 38%. We can see that with PC. Back in 96, it was forecasted to be 225 million PC users in 2000. Actually turned out to be 354 million, 36% underestimation. Even more so with the internet, mobile, and cloud as well. So its potential, the current forecasts for the AI market, currently at 1.8 trillion by the end of the decade, may be underestimating the actual reality of this AI boom as well, as it has the potential to transform just about every single part of society, companies, products, and services that we touch on a daily basis. Not only that, the time it takes for AI to penetrate the market from current early adopters to the mainstream masses. With each new technology our society adopts, that cycle to full adoption gets shorter and shorter every time. Electricity took about 30 years before it went above 20% market penetration. The internet took about 12 years. AI could actually hit that in the 4th or 5th year mark, if you kind of consider the kickoff with ChatGPT as when this AI bull market started early last year, which at that time I made a video as well called AI is shaping up as the next bull market, which I published on the 13th of January early last year. As Microsoft was looking to invest 10 billion into ChatGPT, that was a signal to me that things were really heating up in the AI industry, something that's been around for a few years, but that was the real line in the sand where things changed. And ChatGPT itself as a product is revolutionary, and that's why my thesis in the video back then was that ETFs like bots could likely make for a good investment in the years ahead. And so far that's been true, with the fund up about 50% since I made the video. So the fundamentals and momentum in AI is real, and of course that's spilled over into the stock market. Valuations and sentiment can be another thing though. And maybe if it weren't for the AI boom, the inverted yield curve would have played out like history, and we would have got the recession already. However, now we're in record territory. Over 400 days, bond yield curve's been inverted. Never seen before. And maybe it's the AI that's keeping the recession at bay. And now we've got risk appetite, getting back to those 2021 levels, using the Goldman Sachs model. And something else similar from the 2021 days is meme mania coming back as well. Saw that today in an otherwise soft tape, GameStop trading up 25% after the company raised $1 billion in a share sale, helping to kick the can down their road and keeping the zombie business going for a little while longer yet. And there's a look at the GameStop daily chart, trading up on huge volume today, 105 million shares. And once again, showing up near the top of the option volume leaderboard today, $107 million in call options. Still doesn't hold a candle to Nvidia though, whopping $6 billion. Notional call option value versus 400 million S&P 500. Just shows you how exceptional Nvidia is, not in just their business, but in just the monster trading volumes that it's been getting. However, on some measures, Nvidia and other semiconductor and tech stocks are not as crazy as they were when it comes to valuation metrics of the late 90s. You're looking at some of the most popular, well-traded stocks back then. I'm sure a few of you watching this video will remember Cisco, AOL, Oracle, Nortel, Sun Microsystems, EMC, JDS, Qualcomm, and Yahoo. These were the hot stocks back in the mid-late 90s. Everyone was trading them, and it's funny to think none of these stocks now are nowhere even near the top of the leaderboard in terms of valuation and market cap. It's also funny to think all the investors back then were right. The internet was going to be huge. It did turn out to be a big thing that changed our society. Just that valuations got too far ahead of themselves. You can see that with Cisco in 1999, price to earnings ratio 148, AOL 217. And yes, they were getting the great growth back then as well, as the adoption of internet, companies spending on internet along with consumers was exploding. However, it just wasn't sustainable. Valuations got ahead of themselves, and most of these stocks crashed 80 to 90% between March 2000 and March 2003, when the stock market pretty much bottomed in line with the United States invasion of Iraq in the same month. But that bull market from 2003 to 2007 was actually led by emerging markets, commodities, small caps. Tech was nowhere to be seen. It's only really since the market bottomed again in March 2009 after the global financial crisis that it's been a mega cap tech led rally. But again, it's not all AI, it's not all semiconductors. We've got market-wide and global equity fundamentals improving. We can see that with the earnings revisions in Japan's topics. Europe, S&P 500, small caps. Only thing really lagging is emerging markets here. But the trends over the last 6 months in all of these graphs has been improving. That means analysts are expecting companies as a whole to make more money in the months and year ahead. And earnings revisions, a big driving factor of stock price performance. And so it's no surprise financial markets are very calm here. We can see that in stock market volatility in the yellow, bond market volatility in the purple, Nasdaq in the blue, and even commodity volatility in the red, all sitting near rock bottom lows here. And this market is on a roll. S&P 500 has been positive 23 of the last 30 weeks. Normally we don't go too much further above that. And that's why I think even though we've got a really bullish setup for this year, the market's well supported. We may have already had the biggest dip this year at 6% back in April. I think we could still be in for a little period of consolidation here as the market's been on a roll ever since it bottomed back in October, thanks to Jay Powell pivoting from hawkish to dovish. It's not just corporate profits and loose monetary policy, it's also a bounce back in manufacturing across the world. We can see that in PMIs. Globally and in developed economies, back above 50, that's the level of expansion. And all of this, along with the soft treasury auction today, where dealers had to take up more of the supply, opposed to natural bidders, along with hawkish comments from a Fed member, Neil Kashkari, not ruling out further interest rate hikes, most likely in language to try and cool conditions down. Saw a bit of a material bump up in bond yields today, and look at that, the 2-year, just below 5%, almost back to those levels of the first of the month when Jay Powell and Janet Yellen came out, loosened conditions, got yields down. The bond market pretty much done a U-turn, especially with the 10-year today, up a solid 9 basis points. And that's another reason too, I think should keep a bit of a headwind on the stock market and lead us to potentially consolidate here for a bit. With a sharp fall back down in TLT, now pretty much at its 50-day VWAP. But again, conditions are loose. Bond market's not too worried, as we can see in the price action high yield bonds. Still consolidating, as they have been all year. And so the last couple of looks at the consumer have been weak. Sentiment, retail sales. Contrasting that today was a consumer confidence report coming in surprisingly strong. However, some saying looking underneath the hood, it's not all as good as it seems, as consumers are still grappling and mentioning inflation and interest rates as areas they're concerned about, and they expect it to keep getting worse. So looking at Fed Fund futures, that's a market that prices in where the Fed's overnight cash rate, where interest rates are going to be in the future. Pricing we're going to get a cut in November, another one in March. However, as my daily regular viewers will know, market's been pricing in cuts all year. We started the year with 6 cuts priced in, pushed it back, pushed it back, pushed it back. And so this market is not always right. In fact, looking back in history over the last 20 years, it's wrong more often than not. In the white lines, the actual federal funds rate. In the orange lines is where the Fed funds market was pricing rates going out into the future. So you can see in the bull market, back in 05 going into 08, Fed was increasing rates. The market was pricing then they were going to drop. Actually got it wrong. They got it right in 2008. However, what the market for Fed fund futures got massively wrong, through no fault of their own, because it's what the Fed should have done, is ever since 2010 all the way to 2016, for 6 years, the market was constantly pricing in. The Fed was going to increase rates. They were going to increase rates. They were going to increase rates. Nope. The Fed kept rates rock bottom lows all that time. Even though after 2010, especially after 2011, the economy, stock market, risk markets, credit, everything was fine to increase rates. They finally caught on. The market priced it well going in 17, 18, 19, in which they had already stopped jacking rates before COVID. Market priced they were going to stay flat. We got COVID, back down to rock bottom lows, and the market got it wrong again. They were pricing they were going to stay down there for a while, maybe get a little bit of a bump up. However, the Fed surprised, shot rates up at record speed, and now here we are now. The market pricing in rates to come back down over the next year or two before bottoming out. So the chances are this forecast is wrong. So what does that mean? That means maybe we get something different and rates stay up here for an extended period of time. And who knows, maybe they even go higher. And wouldn't that catch a lot of people off guard? The truth is nobody knows, because so many external surprise factors can affect the path, like COVID did, and the blow up of the subprime mortgage market in 2008 did as well, along with an overly aggressive and loose Fed did in the 2010s. And unfortunately, the result on the real economy and real people of all that rock bottom interest rates, in addition to quantitative easing, the Fed electronically printing $9 trillion of money to buy treasuries and mortgage-backed securities, among other things, has skyrocketed US private sector financial assets. Basically, that means stocks, bonds, mutual funds, ETFs, been growing a lot faster than the economy, and that's typically to the benefit of those at the top, with the expense handed down to those below them. And so the US stock market has been the exception. After the last 10-20 years, has been justified with much stronger earnings growth than the rest of the world. However, now looking at forward price to earnings ratio, it's the biggest gap ever between America here in the grey with the forward PE above 20 and the rest of the world here in the yellow with a forward PE below 14. And so like I always say, if you're looking to insulate your wealth from the potential underperformance of one country, whether you live there or not, it's always a good idea to diversify by investing abroad. And don't get me wrong, the US stock market is likely to remain the biggest stock market for the rest of our lifetimes. It is the exceptional place to invest. I'm still heavily invested in the US stock market. However, I also like to diversify across the globe. And just looking at the CAPE ratio for some of the largest economies, you could think of the CAPE ratio as the 10-year PE. Kind of evens out the business cycle when looking at countrywide valuation. At last reading, the USA had a CAPE of 33, which is historically very expensive. Only really got above that in the late 90s. And long-term averages, somewhere around 18-20. The cheapest right now is China at 11. However, not too far behind that is Brazil at 12.7, which historically is pretty cheap. And even though Brazil is still a developing economy, they're a resource-rich nation. Stock market heavily focused on commodity stocks. And what you're looking at here is a clean monthly chart of the most liquid Brazil ETF traded on US exchanges under ticker EWZ, and currently on its 5th consecutive down month, in which I think at current levels is good valuation. And it's still well off the commodity bull market of 2007 highs, in which it skyrocketed almost 2,000% in just 5 years, along with the commodity market and other emerging markets as well, before having a monster crash in 2008. And so looking at this fund, it holds 51 Brazilian stocks, dividend yield really healthy there at 6.5%. And just looking underneath the hood at what it owns, commodity stocks, energy minerals, and non-energy minerals make up about a third of the fund. And there's a look at its biggest holdings, Vale, and other big, large oil and gas commodity stocks in Brazil. And so if we are going into another secular commodity bull market, then Brazil and this ETF could benefit immensely, especially given the starting valuation where we are right now. Its CAPE ratio at 12 and dividend yield at 6.5%. Even if we don't get the secular commodity bull market, this could still just keep consolidating whilst investors collect the generous dividend yield as a backup. And staying on commodities, we got oil ticking up today as we go into the OPEC meeting this week, which still control over half the global crude market, in which the market will be looking for the production cuts that especially the Saudis want to be rolled over or extended. However, we've still got Russia producing a lot, still quite a lot of tension between Iran and Israel, and the potential for that to spill over again. Either way, the market's found support to start off this shortened trading week. Crude adding on 3%. Now back above $80 a barrel. And unless we get a real surprise, I'd be surprised if we took out this $83 or $84 level barrel, as the Biden administration has been releasing strategic reserves in order to keep it down. And I'd say if oil traded back up towards $85 a barrel, they'll probably come out with something again, at least in their language, to try and talk the market down. We got other investment houses like UBS saying there's room for gold, oil, and copper to rise, keeping the commodity rally alive. And if they're right, that means inflation still going to have a strong tailwind underneath it. And there's a look at the commodity complex index fund DBC, actually trading pretty strong there today, close to breaking out to multi-month highs. Gold holding ground, another big bump up for silver, and agricultural commodities as a whole, back to trading above their 50-day VWAP. Over to crypto, this market too has improving fundamentals, and why I expect it to break out to all-time highs. Not just on sentiment, hype, loose liquidity, however for this reason right here, shifting regulation. Ever since Trump came out, changed his tune, said he's going to block the creation of a central bank digital coin. He supports Bitcoin holders' rights and even started accepting crypto for political donations. Some have said that caused the Democrats to fear missing out, giving Trump advantage. And so they too have jumped on board, and now it looks like the US government as a whole, from being instigated from Trump, is going to come around to embracing the private crypto industry, and a central bank digital coin doesn't look like it's going to be happening anytime in the near future. However, I still wouldn't rule it out potentially in the years ahead, as I don't think the US government in the long term really wants to lose their grip over global finance, ability to issue sanctions, so on and so forth, with Bitcoin becoming the global reserve currency. But can you just imagine what would happen to Bitcoin if Trump came out and said he wanted to place some US reserves into Bitcoin? And we can see that changing tune from Washington trickle down all the way to the SEC. With Ethereum ETFs pretty much being approved and all good to go, that could spill over not only to Ethereum, but also to other cryptos, as they too could be also listed on stock exchanges under an ETF wrapper, allowing pretty much anybody in the world to click a button and buy them with ease. There's a look at the price action of Bitcoin, still forming a bullish flag formation, and Ethereum, an even stronger bull flag formation, and I'd say both of them are on the verge of breaking out to all-time highs and potentially going on a good run going into the November election. And if Trump wins, there's no telling how high they could get, as this could turn out to be the mother of all speculative bubbles, even though some say we're already there. And the way the stock market in the States works officially changed today. Stocks now settling in 1 day with the move to T+1. That's the trading date plus 1 day. That's the process in which shares are delivered to buyers and cash to sellers. Basically just speeding up the process, which has been a long-term trend. It used to be T5, T3, T2, T1. Pretty sure in the years ahead it'll be instantaneous as well. But for a lot of us who trade with margin accounts, we don't even know it, as it's pretty much instantaneous, as we can trade straight away after selling our shares with that cash. And just before I dive back into the charts, just want to let you guys know, for the next few days only, I'm running a Memorial Day sale, 33% off all my products. So if you're interested in getting my online trading course, which is 12 hours of on-demand content, or all 25 of my custom TradingView indicators you see me use on the charts every day, or my automated stock trading bot, then click the link below this video, head on over to my website clickcapital.io and use coupon code MEMORIAL33 to save big on all my products just for the next few days only. And so it's a bit funny looking at stock market breadth. Actually got a dive today, especially in the short term, 35% of stocks above their 20-day average. Like I showed you, it's really bond yields separating, a little bit of a bounce back in energy. It's really semis that have come back, along with mega cap tech still holding up. That's what's still holding up the growth versus value. Momentum, quality, and growth factors still uptrending across the board, even though a lot of the market's weak, having a bit of a pullback underneath the hood here. But option dealers are not all that worried. VIX still trading on a 12 handle. We are creeping back a little bit and volatility risk premium, 2.2 points above realized. And something that's jumped back the last couple of weeks is the skew index. That's the relative price of out of the money put options on the S&P 500 compared to at the money. So currently about 52% more expensive, and that typically happens before the market rolls over. After the market rolls over, like it did in 2022, skew index will come down because the event's already happened, and then it'll increase again going into that. However, it can get higher, just like it did in July 21, got up to 170. So even though at the money options are cheap right now, if you want some out of the money insurance, you will have to pay up a little bit for that. This is China consolidating a little bit after it had a decent pullback last week. We're looking for this trend to hold above the 50-day VWAP. Really good price action for my favorite, Tiger Brokers. Huge volume rip today, nice big momentum bursts we've been getting over the last month here, along with clean energy holding up pretty good as well. Another strong rip for one of my favorites, hydrogen. Higher highs, higher lows. Up 4.5% today. This is really good short-term price action and often leads to a medium-term uptrend. Absolute dive in the spread of value stocks versus growth, with high beta versus low volatility coming back, along with the bump back in inflation expectations. Global shippers are enjoying a months-long rip here. You can see that in the boat ETF. There's semis back to breaking out to all-time highs. Fresh equity, IPO ETF, trading firm as well. And that bump back up in bond yields caused yield-sensitive sectors like home builders to fall again today, along with a bit of a pullback in REITs. Normally that would cause a bit more of a fall in utilities. However, like I've been saying, utilities are trading on the AI boom and the huge explosion in electricity demand now. Winning factor today was growth with low volatility, sharply contrasting that. Still got a pullback going on in cannabis. I'm looking for it to find support around 750. If not, another good buy the dip zone. There's Tesla still consolidating just above the 50-day VWAP. Price action appears a little supportive here. And the winning stock last week, off to another good start this week. First Solar, trading firm today, along with a bump back in Enphase. Trump Media, still volatile as ever, up 9% today. And bank stocks really reacting to those bond yields of late, really not liking them going higher. We seem to be pulling back a little bit in financials here. All right, so there we are, guys. Just looking out at the week ahead, we've got GDP data coming on Thursday, and then the big one, personal consumption expenditures, PCE inflation data on Friday. That could really get the bond market moving, and we'll see whether the S&P can have a stab at these highs from that bearish engulfing and take it out, which could potentially happen if inflation data comes in soft. Otherwise, for now, we've got bond yields bumping back up, oil bumping back up along with energy, and it's pretty much semis doing all the heavy lifting for the growth and main indices, led by none other than Nvidia, the true exceptional stock in this market, and like I said, potentially our lifetimes. However, its business growth and stock price growth will not last at current rates forever. That's almost guaranteed. No one knows when it's going to top out though. But for here and now, what an absolute monster we're all witnessing in front of our eyes. Thanks very much for tuning in to the Daily Market Review. My name's Jared, and I hope to see you again tomorrow night. Cheers.